Hello smart investors, if you've only been in the market for 1 or 2 years, then I have a special caveat for you in this video. New portions of news and statistics are here. Many investors still stick to the strategy of choosing single stocks or collecting a portfolio, despite all the latest advances in science and technology, statistics and the opinions of Nobel laureates. What is this? There was a very crazy 2020 where we saw a huge crash and very fast rebound like from a bailout. The smartest investors say, it doesn't matter whether you made money in 2020 or lost money, neither one nor the other is not a reason to evaluate yourself as a good or bad investor. How's it? What do they mean and why? After such a crazy period of explosive growth in the markets, we will have a bunch of confident investors. Millions of those investors who got good results for the wrong reasons. Damn it! Do I envy those who bought Tesla or Apple on time? Well, to be honest, a little bit. But I would not have bought it if we were at a similar time again. I mean stocks, of course, not cars and fruits. Of course, it was also hard for me sticking to the plan and earning just a market return while beginners easily did 70-100% and shouted about it at every corner. Well, those who survived, of course. For some reasons, those who did not succeed magically lose their voice and desire to broadcast to a wide audience. Don't be like them. Keep talking about your investment failures. Mistakes are often more instructive than successes. So a piece of statistics, what do you think? How many shares showed positive returns from the end of March to the spring of 2021? 96% of the stocks, guys. 96%. What does it mean? This means that 96 out of 100 people have reasons to consider themselves a very smart and talented picker of individual stocks. Well, considering that probably only some of them have surpassed the index, then 80% people out of 100. It doesn't matter which stocks you choose in 2020, 96 out of 100 stocks have made a profit. An awfully wonderful year. And yet this is an incredibly large amount. It's common for a human being to attribute positive results to his talents and to attribute negative results to chance, circumstances, bad luck and so on. This is how the brain deceives us every time. Why shouldn't we follow his lead in this case? Because you are in control of your capital and each of your cognitive errors and biases cost you your money. If not today, then tomorrow. Money that quickly appears on bubbles tends to evaporate in an even shorter period, sometimes in a week or days. Thus, over the last year, no matter what stock you bought, you would still generate positive returns, even in risky or weak emerging markets. If you have never played in a casino, then I do not recommend you starting. But those who have played know how it happens. Sometimes luck is very destructive. People who started their casino games with good results reinforce this pattern in their minds, believing that it is possible to make money in casino. They fall into gambling incitement, they are confident that they have caught their luck by the tail. The funny thing is that they start a game with the small sums, and then comes a logical thought and regret, I had to bet more. And they do it, and here comes the FOMO, fear of missing out. And they are starting to invest more and more in cryptocurrencies, meme stocks, popular stocks, with gigantic valuations, SPACs, HIRACs and so on. Then everything comes to some natural average and these people are in debt right up to their neck. They do not have any fun. This period is over. Probably 2021 is not yet an easy year for individual stock investor. Ben Carlson drilled down into the Russell 3000 to see how many stocks currently have double-digit drawdowns from their 25-week highs. The list was bigger than he expected. Russell 3000 is an index. While the index itself is close to all-time highs and is about 13% this year, individual stocks do not share this optimism at all. 84% of the shares lost 10% or more. Selecting individual stocks is a tricky business. Do you remember the statistics that more than half of the stocks on the long horizon will bring you negative returns? Why is this happening? Is it really so hard to choose a good company and buy its shares? Yes, this is a truly an almost overwhelming task, despite the fact that asset prices are in fact not quite correct every day. If they were not correct today, then without the newly received news about the company, they would not have changed their prices, even by 1%, and prices nevertheless sometimes fly by 10-20% or more every week or month. I have simplified this idea a little bit, of course, but the meaning remains the same. Investors vote for the price using the best analytics and information with great speed to bring the asset prices to a certain balance. While the subject may seem balanced, this does not mean that we have found its real geometric mean. Everyone cannot be a winner. Most securities simply disappoint their investors and even lose to bonds. And if it seems that this does not apply to some countries, such as it's there in Europe some weirdos have done, our United States of America market is a rock, this is not true. This pattern has been confirmed in 35 of 42 countries in more than 90 years. The average Greek stock has lost 75% of its value, 50% of Australia and 37% of Germany. Even the great Germany with great economy for sure. But nevertheless, over the same period of time as studies show, all the stock markets of these countries gave positive returns. By starting to play this game, you obviously put yourself in a losing position. Even if you imagine that you will conduct a high-quality stock selection and spend a lot of your time on it. Yet the investor journey is more about increasing active income and reducing living costs than trying to earn yourself an additional 2% annual return, putting yourself at greater risk. Avoiding big financial mistakes is more important than trying to beat the index, especially if you are not the owner of billions. And if you are owner of a billion, then like this video. Maybe I will become a billionaire too and teach you how to overtake the indexes. But I just think that billionaires or owners of extremely large fortunes simply won't watch these videos because they watched them a year ago or two. Often people start buying stocks that they like, 2 or 3 companies, and every day they start checking their portfolio, how are they doing their dear stocks and assets. And as luck would have it, they buy those securities that are usually the sexiest, most hype, most risky, in which other novice investors are crammed, stocks that have been dispersed from that there is not much upside left in them, but the risk of bankruptcy are easily. At the same time, a diversified investor will not lose much if these shares begin to fall in price strongly, but those who keep 2 or 3 shares in their portfolio will be very painful. Therefore, when you buy several shares and stop there, then probability of losing from you is much greater and the probability of gaining is much less, since the price is calculated on the basis of a diversified portfolio in which there are no individual risks of this stock. The risk-return ratio for this particular stock, when it alone in your portfolio, is not in your favor at all. The risks are off of the charts. Therefore, when they say that diversification is kind of good, you can do it, but I would strengthen this statement. It's better not to meddle in stocks without diversification. I hope you get value from this video and I want to see you again and again in the next videos. So please subscribe to the channel and press the like button for YouTube algorithms only. 100% not for me. Goodbye.